Hello everyone, welcome back to the class. So in last class, we are dealing with some basic terminologies that we are going to use in the business. So in last class, we come to know across the different types of debtors and assets. What are different types of assets like long-term assets, short-term assets, current assets and fixed assets, monetary assets and non-monetary assets and vesting assets. You come to know different terminologies that we are different types of assets, and each and every assets has its own specifications and limitations like that. So in this class also we continuation will deal with some more terms that we regularly used in the business while doing our business. So let us start with investments. So investments usually we can heard many times. So investments means what? Investments means what basically? So usually when we are doing a business, business will get profits. So sometimes business will get continuously profits. So they'll get more surplus. The business will earn more profits. In generally, business will earn more profits. The business will have the money what they expected. They have, that means they have a sound financial position. So on that time, what business want to do? So we are all know holding of money is nothing but wasting of the money. If you have 100 rupees in your pocket from morning till evening, you did not spend anything. So next day morning also you have say 100 rupees nothing but it's loss. It decreases its value. So any business don't want to waste its money. So when they have a surplus fund, obviously that the diversified into some other useful way. That means from that money they multiplies some money. That means they'll get some more benefits instead of idling of the money. So idle money is nothing but that means it's waste. So any business don't want to waste that money, that they are going to get some returns about the idle money or surplus money. That is what we call it as investments. So here investments refers to the company is going to invest some money in some other securities, like the company may buy some gold or silver, or the company may buy invest in some mutual funds or any shares, or else the company may give a loan to some other borrowers. So anything, so anything the company, it's investments, the kind of assets the company is going to invest its money into in some other way that will give returns to the company. That is what we call it as investments. So any surplus money of the business, it takes to pour into some other useful way, either in the form of any securities, purchasing of land, or investing in gold bullions or silver bullions, or purchasing some shares, securities market or mutual funds, anything, those kind of thing activities what we call it as investments. So investment made by the company into some other company or securities, that is what we call it as investments. So next term, goodwill. Commonly we can heard many times goodwill. Goodwill means what? So goodwill is an asset basically. Goodwill is an asset. You can call it as intangible asset because we cannot able to see and touch. So goodwill is an intangible asset. How the goodwill generated? So goodwill will be common asset for all the business. I said no. So every company may not able to earn the goodwill, may not able to showcase the goodwill in its balance sheet. So why? Because goodwill is not an easy term. At the same time, goodwill is not an easy asset that every company, because no company cannot buy the goodwill. Goodwill is generated. Depends upon the business, how they are doing, depends upon the efficiency of the business, depends upon the company's profits, depends upon the company's reputation, depends upon the company's service towards society or towards the customers. So that is what we call it as name and fame of the company. Even though they have some specified calculations, I said already, goodwill is not possible to gain every company unless for consistent profits for 5 to 10 years. 5 to 10 years. In long term, the company is going to earn the profits every year. The profits is keep on increasing. Its reputation is fine in the name of public image. Its quality is good. Its service is good. So by taking of all the factors, they can create an asset. That is what we call it as goodwill. In simple terms, what we call it as name and fame of the company or reputation of the company. We can call it as goodwill. We can call it as goodwill. Then next, we can see one more term, depreciation. So depreciation is nothing but depreciation is an indirect expense. Depreciation is an indirect expense. So depreciation, decrease in the value of asset, we call it as depreciation. Decrease in the value of asset, we call it as depreciation. How in the sense? Suppose today we are going to buy one chair, cost of ₹1,000 rupees. The chair price is ₹1,000 today. The same chair price after 1 year, the price is going to be decrease. Obviously the price is going to be decrease. So the difference price, for example, today the price of chair will be 1,000. So next year the price of chair price will be 900. So difference between the opening and closing, what we call it as depreciation. So decrease in the value of asset due to wear and tear, that means utilization, either might be chair, machinery, anything, we can call it as depreciation. So we come to know that the value will become low due to usage or obsolescence. I hope you remember that depreciation chapter in your first PUC at the end of your syllabus. So depreciation nothing but decrease in the value of asset over a passage of time. That is what we call it as depreciation. So we have different methods of computation of depreciation, straight line method, annuity method, etc. So depends upon the IT Act. So what are the methods suitable that suggest we are going to use that one. So that is what we call it as depreciation, nothing but decrease in the value of asset. At the same time, this depreciation showcases to identify the requirement of new asset. That is for that is they can charge the profit. They can charge the profit. That is what we call it as depreciation. Then liabilities. So liabilities commonly we can use in a business term. So you remember in the balance sheet we can showcase only two headings. So it is assets and liabilities. So what are liabilities here? What are liabilities? So liabilities nothing but business has to pay to the outsiders. Either might be anything. Business has to pay to the outsiders. That is what we call it as liability. Liability means where the person owes to pay the money to some other person. The person owes to pay the money to some other person. And so here business has some dues to the third parties. The term we can use liabilities directly. It's a liability. Business has liable to pay something else. That is what we call it as liabilities. That is what we call it as liabilities. So liabilities here two types. One is long-term liabilities or short-term liabilities or fixed liabilities or current liabilities. So long-term liabilities or fixed liabilities refers to the liabilities which will be in long period in nature. For example, business has to borrow loan from the bank. The time period will be 5 years. The time period will be 5 years. So those kind of things what we call it as long-term borrowings. Long-term borrowings. Then short-term borrowings here refers to the business has to clear the debts within 12 months. Within 12 months. That is what we call it as short-term liability. Example, bank overdraft you can take. If you overdraw today 120,000 extra, you have to clear within 3 months or 4 months or maximum 6 months. Creditors, that means we are due to the suppliers. The time period will be less than 12 months and bills payable. So any kind of liability, the time period will be less than 12 months. We can call it as short-term liabilities. So time period will be exceeds more than 12 months. What we call it as long-term liability. That is what we call it as long-term and short-term liabilities. Then liquidity to owners. Liquidity to owners. Usually the owners will have certain claims of their existing business. That means they have certain rights to withdraw the money, what we call as drawings. We can see in our first session. So apart from the drawings, they can charge some assets. They can charge some assets like stock or any other thing, withdrawing any other thing. That means they can charge some cash, etc. That is what we call as liquidity to owners. Best example, profits. Because they are the owners, they have certain claims. Claims nothing but they have a right to get the things like assets and profits. We can use the term liquidity to the owners. It's not been for a short term till they continue. Until unless your business ends, the owners will have certain obligations to claim the business activities like profits or some assets, anything might be. That is what we call it as liquidity to owners. Liquidity to owners. Then creditors for expenses. Creditors for expenses. So creditors for expenses here refers to the expenses occurred but not paid. For example, salary I have to pay at the end of the month to my employee. So due to some financial crisis, I am unable to clear the salary. I said I'll give you next year. This month I can't pay the salary, I can give you next year. So what it is called to me? Outstanding liability. It's outstanding liability. Expenses occurred but not yet cleared, like wages, salary, any expenses. Expenses occurred but not yet cleared, what we call it as creditors for expenses. Creditors for expenses, or else you can call it as outstanding liabilities. Outstanding liabilities. Expenses occurred but the firm is not going to clear, it is still due. We call it as creditors for expenses. Creditors for expenses. Then accounting period. Usually we should have certain standards that we come across in our principles and conversations, and accounting period is one of the concept. So accounting period refers to it will be the proper duration for the business to calculate the activities happened. It is what we call it as accounting period. Accounting period. For example, 1 year, what we call it as Indian financial year, 1st April to 31st March of every year. That means we start the books of 1st March and we close the books of 31st March of the every year. So the duration that is what we call it as accounting period. That is what we call it as accounting period. So at the end of the year, we come to know the business is going to earn profit or loss, and we can display the financial statements like balance sheet. So accounting period is very crucial to identify the activities or happened between the particular year, between the particular time period. It is what we call it as accounting period. So in India, the financial year will be 1st April to 31st March of next year. Because you can take 2020 a financial year, 1st April starts, so ends with 31st March 2021. That is what we call it as Indian financial year. So English financial year that we know, January 1st to 31st December. So that is what we call it as accounting period, nothing but time period. Then stock. So usually we can heard many times the term stock. The stock is nothing but the unsold goods. The unsold goods or unused goods that are been there in the business. So we can call it as stock. We can call it as stock or inventory. So it might be again further classified into 2 types. So opening stock and closing stock. Opening stock in the sense means at the beginning of the year, at the beginning of any accounting period, what kind of stock you have, we can call it as opening stock. At the end of the year, do we have some more stock is left with us, we call it as closing stock. That is what we call it as the opening stock and closing stock. If any stock is there at the beginning of the year, beginning of any accounting period, we can call it as opening stock. At the end of the accounting period, we call it as closing stock. So thank you.